I don't know how many of you own homes. Um, well, a lot of people lost their homes this week in Los Angeles and the vicinity. I talk quite a bit about the future of the younger generation, how the home ownership is completely unaffordable now. And I talk quite a bit about the Fed pivot. So September 18th of last year, Fed started lowering interest rates, something called the Fed funds rate. And you would think they lowered the interest rates, mortgage rates would go down because mortgage cost, interest cost, mortgage payment is the largest part of your home buying adventure. Okay. You need a mortgage. Unless you have the cash, you plop it down and you buy it for cash. How many people do that? No. So I talk quite a bit about the future of the new generation, of them being able to afford a starter home. Well, a starter home in California is $1 million. Any way you look at it, a shack in the ghetto is $1 million, literally, these days. So they have no chance, right? But then you would think, okay, we're going to catch a break here. Fed is lowering the rates. Mortgage rates are going to come down. Well, mortgage rates are not tied to what the Federal Reserve is doing, unfortunately. A lot of people think, yeah, my credit card bill is going to go down, or the interest is going to go down, or my car loan is going to go down. Well, no, because the Fed can do certain things, but then all these interest rates are tied up to the 10-year note, the 20-year note, and those move independently of what the Fed is trying to do. But the magnitude of the move, it's the first time I'm seeing this in my 30 plus years. Fed lowered the Fed funds rate by 100 basis points, and the market decided Fed is smoking crack. None of this is going to happen. Inflation is going to come back. In fact, the reason the market's selling off today heavily is because inflation may come back, and that'll be the killer. Because Fed was taking a little bit of a victory lap, saying, yeah, we need to cut rates. I'm like, why are you guys cutting rates if the economy is doing well? But different topic. Sticking with the topic, home ownership is completely unaffordable for pretty much everyone. Why? Because when the inflation showed up, Fed raised the rates from 0 to 5%. 30-year, fixed mortgages went from 3.5% to 7%. Then the Fed pivoted September 18th of last year and started cutting rates. You would think the rates would go down. Initially, they kind of did. And now we're facing this. Well, home ownership cost comparison. In 2021, this is not going back too far, 2021 versus 2025. What's the difference between 2021 and 2025? Since the great financial crisis in 2008, we had something called ZIRP, zero interest rate policy. That's when the mortgages were 3.5% for a 30-year fixed. That's what most people get when they purchase a house. Well, in 2022, Fed started raising rates because inflation was getting out of control, right? And they raised the rates from 0% to 5%, and mortgages went from 3.5% to 7.5% on the 30-year fixed. This is with good credit, by the way. So in 2021, median home price was $346,000. 10% down payment would be $34,600. Monthly payment at 3% interest rate, that's where the mortgages were, would be $1,313 a month. So at that time, right, ownership over rent, being a renter, was a huge advantage. Okay, well, let's fast forward to 2025. In 2025, median home price $405,000. You guys see what's happening here, right? It's called inflation, people. Fed can say inflation is 2%. It's not. It's 6-7% a year. And every single hard asset that you guys are aware of, from the stock market to gold to real estate, it keeps going up because of inflation. Real estate is one of the best inflation hedges if you can afford it. But look what's happening here. In 2025, median home price is $405,000. 10% down payment, $40,500. Monthly payment at 7% interest rate, which is where the 30-year fixed is now, $2,425, almost double. Buying a home in 2021 with a 30-year mortgage meant you spent a total of $473,000 in principal and interest. In 2025, you spend a total of $873,000 in principal and interest to pay off your 30-year mortgage. That's $300,000 more, or 63%. in a less than 4-year difference. Well, this is exactly why buying a home in the for the average American or a 30-year-old couple, even college educated couple, is almost an impossibility these days.